Look at your screen. Silver's in the low 70s, up 3 or 4% on the day. No war headline, no emergency Fed meeting. Half of Wall Street is still hungover from New Year's Eve, and yet the metal they spent all of last year trying to cage is already kicking the bars on day one. This isn't what a calm market looks like. This is what a spring looks like when somebody finally lets go. They told you the blow-off top was behind us. They told you that spike into the 80s was just speculation, that the smart move was to sell, be grateful, and go back to your regularly scheduled tech narrative. Today, the market quietly answered with a green candle that feels less like a bounce and more like a slap. Silver is refusing to play the role the banks wrote for it. On the surface, the explanation is simple enough. The dollar opens the year soft, drifting under that neat little psychological line at 99. Headlines mumble something about consolidation, healthy markets, soft landing. The same broken lullabies they sing before every accident. But the tape is telling a different story. The tape is showing you a metal that was supposed to be exhausted, limping, out of breath, and instead is sprinting off the starting line. This is not a polite New Year rally. This is a warning shot. Let's start with the obvious. Silver is up several percent on the day, gold is only nudging higher, and the dollar is bleeding slowly in the corner. That's not random noise. That is the market repricing risk and money at the edge of a system that burned an entire year trying to hold the line. Think about that $70 area everyone told you was overstretched. 70 isn't just a price tag, it's a fortress wall. They lined up sell programs there, they threw headlines at it. They pushed every scared holder they could find into handing back ounces for paper dollars. And yet, here we are, the first real session of the year, and the battering ram is already rolling back toward that gate. They tried to cap it in the mid-60s. They failed. They tried again in the high 60s. They failed again. Now we're back in the 70s, and the price is the one writing the script. If this was just a casual short-term trade, why are we seeing this kind of move on one of the quietest calendar days of the year? Because this isn't a meme stock on a message board. This is the primary industrial and monetary metal at the center of three converging storms: currency debasement, an industrial arms race, and a slow-motion run. On paper, registered jumps by a few 100,000 ounces. It looks like new supply. In reality, it's the same bar with a different label. That's not a robust reservoir. That's a slow bleed being hidden with bandages and lighting tricks. The vaults aren't fine, they're bleeding quietly, week after week. If silver is in such a glut, if all this talk about tightness is just doom porn for YouTube, then why does the exchange need to keep reclassifying metal to keep the registered bucket from looking dangerously thin? Why are we seeing millions of ounces going out the door in delivery at the same time that the price, supposedly topped out, refuses to stay down? You know the answer. Because the people who actually need the metal don't care about CNBC's narrative. They care about having enough ounces to keep their own machines running. Let's talk about those machines. Look at the PMI numbers coming out of Asia. Taiwan flipping back above 50. South Korea pushing back into expansion territory. Order books fattening up again. And the theme behind it all? Not value stocks. Not ESG. One word: chips, semiconductors, AI, data centers. When you hear that a factory in Asia is ramping up production for high-end chips, you're not just hearing a tech story, you're hearing a silver story. Because every server farm, every AI accelerator, every edge device in that entire stack needs conductive metal, needs connectors, needs relays, needs the little, boring, unsexy parts that quietly soak up physical silver in grams and milligrams. People like to say, yeah, but the amount of silver in each device is tiny, it doesn't matter. That is like standing at the bottom of a dam and looking at a small crack in the concrete and saying, it's just a little line, it doesn't matter. The scale is what matters. When you manufacture tens of millions of devices, and each one drinks a tiny sip, over time, the reservoir upstream starts to drop. Now picture the procurement manager at a giant solar company or cloud provider. It's the first week of the year, they're watching the silver price jump a few percent in one session. They've got a spreadsheet with their projected metal usage for the next 12 months. The line that used to be safely under their cost budget is now brushing against it, even after last year's healthy correction. Do you think that person is thinking like a trader, hoping for a pullback to buy the dip? Or do you think they are thinking like someone whose job is on the line if the factory has to idle? This isn't speculation. This is procurement. And on the other side of that equation are the banks, the funds, the speculators who sold them price insurance in the form of forward contracts and swaps, often backed by paper promises on COMEX. As industrial demand hardens and the price moves up, those insurance writers quickly realize they're short something more dangerous than a ticker. They're short the lifeblood of entire industries. Now, let's add another layer, the currency. The dollar ended last year wounded, not dead, not collapsing in a straight line, but clearly weaker, down nearly 10% over 12 months, sliding under that neat, comforting triple-digit index. At the same time, the US government's borrowing needs have turned into. This is why pricing power is drifting east. Not because some committee voted on it, but because that's where the real bids are. That's where the cash is. That S where the buyers treat silver not as a speculative toy, but as a vital input they must secure no matter what the chart says. The West is still pretending it runs the price. The East is quietly running the flow. You can already see the political system catching up, at least on paper. Silver now sits on official lists of critical minerals. That's bureaucratic code for we woke up late, but we finally realized this stuff actually matters. It's also a warning label. Expect more interference, export controls, strategic stockpiling, national security language that can be used to justify almost anything. When a metal graduates from commodity to critical, it changes who competes for it. You're no longer just sharing the pool with jewelry makers and ETF issuers. You're sharing it with defense ministries, energy planners, and tech giants with trillion-dollar market caps. We are not in a market anymore. We are on a battlefield. And on this battlefield, the side with the metal wins. Let's go back to the exchange for a moment, because this is where the game becomes life-threatening for the people still clinging to the idea that silver is just another chart. Volatility in silver has been running hot. Implied vol measures in the futures market show that even after cooling off from the extremes of last year, the options market still expects big swings. That matters because volatility is the fuse that lights margin calls. When vol spikes, clearinghouses raise margin requirements. When margin requirements rise, leveraged players get a choice: wire in more cash or cut positions. In a one-way move, that decision isn't really a decision at all. They sell what they can, not what they want, to stay solvent. And last year, that dynamic crushed a lot of longs. They got too excited at the highs, got over-levered, and then watched forced selling hammer the price back down. Banks and shorts took their victory lap. But here's the thing about a spring. Every time you slam it down, you store energy. You can't see that on a day-to-day chart. You see it in the structural picture. Vault stocks trending lower over years. East-west flows shifting. Industrial demand refusing to roll over even in a slowing economy. Governments quietly reclassifying the metal as strategic. So when you see silver open the year with a violent green candle in a supposedly quiet session, you're not seeing noise. You're seeing a little bit of that stored energy finally leak out. If this was just a normal correction at the end of a long bull run, why are the banks acting more nervous than you? Ask yourself, who is truly scared by a 3 or 4% jump on day one? The long-term stacker with metal in a safe, no leverage, no margin calls? Or the desk that wrote options all year, is short futures into delivery, and knows the vault they rely on is more bookkeeping than bottomless pit? Now, I want you to imagine the psychology on that desk this week. It's the first serious trading day of the year. The senior guys are still flying back from their villas. The junior trader is the one actually watching the book. Silver's up 3%, then 4%. The dollar is down. Asia PMIs have just surprised to the upside. Headlines are starting to mention AI demand and industrial revival in the same sentence as precious metals. The phone rings. It's risk. Walk me through our silver exposure. Silence. A quick scroll. A realization that the nice, tidy spreadsheet that assumed flat or gently falling prices into Q1 is already off by a factor of, oh no. That silence you're hearing? That's not calm. That's a spring being loaded. On the other side of the world, a completely different kind of conversation is happening. A procurement team in an Asian manufacturing giant is meeting. They've seen the same PMIs. They know their order book is filling back up. They know their clients, the big Western brands you recognize on your phone and laptop, are forecasting aggressive build-outs for AI hardware, edge devices, solar, EVs. They pull up the silver chart. They see the spike into the 80s last year. They see the pullback. They see today's move. One of them asks, very quietly, what happens if that high wasn't the top? What happens if that was just the dress rehearsal? This is not a rally. This is a surrender. It is the surrender of the idea that silver can be treated like a sleepy byproduct, forever capped by a handful of Western banks throwing paper at it whenever it gets uppity. Not zero, not physically barren. They will always be able to show you some pretty bars for the cameras. I'm talking about the surplus, the comfort cushion, the layer of inventory that makes the system feel safe. Once that surplus is gone, every new buyer becomes a threat. Every new delivery demand becomes a stress test. Every refinery delay, every shipping disruption, every political spat over export controls starts to matter. At that point, silver stops being a quiet line on a commodities screen. It becomes a bottleneck, a choke point in the global machine. If one big tech company decides, in a boardroom somewhere, we don't trust this market anymore, we're going to pre-buy 3 years of silver needs while we still can, what does that do to every other player downstream? Who gets the metal? Who gets the excuses? This is where you, the individual stacker, the prepared observer, have an advantage that no bank, no government, no CIO can replicate. You're small. You can act before the stampede. You can act without committee meetings, without regulators, without risk departments. But that advantage only matters if you understand the phase we're entering. We are leaving the era where silver was dead money, where you were mocked for holding it, where the only respectable trade was chasing the latest AI stock at 50 times sales. We are entering an era where physical scarcity, industrial necessity, and monetary panic are converging on one small, finite pool of metal. The system will try to buy your lifeboat back from you on the way up. It will tempt you with tidy profits. It will whisper, "Take the win, don't be greedy. Didn't you say you'd sell if it ever hit 70, 80, 90? That whisper is not your friend. That whisper is the sound of a structure that needs your ounces more than you need its paper. There will be pullbacks. There will be violent, sickening red days. There will be sudden slams at thin hours designed to shake out anyone who didn't really mean it when they said they were in this for the long haul. The cartel doesn't give up. They adapt. They delay. They use every trick left in the playbook to make you doubt your eyes and trust their narrative. But they cannot print metal. The East can't print it either. They can only mine it, refine it, ship it, and lock it down. What they can print are purchase orders, binding contracts, long-term offtake agreements that quietly reroute future supply away from open markets and into closed loops. The West can print contracts. The East can print purchase orders. You can print neither. All you can do is decide now, before this next phase fully ignites, whether you want to be on the side holding the promises or the side holding the metal. In the months ahead, watch the levels. Watch how the market behaves around the 70s, the 80s, the first time it flirts with triple digits. Watch how the mainstream coverage shifts, from mocking to cautious to panicked. Watch the vault reports, the delivery notices, the little line items that nobody on TV bothers to translate for you. Most of all, watch your own psychology. When you feel fear because the price is screaming higher, ask yourself, fear of what? Fear of missing out? Or fear that the world you grew up in, the world where fiat was safe, bonds were boring, and metals were relics, is finally, visibly breaking? When the history books talk about the end of this system, they won't show you the headlines. They'll show you the balance sheets. They'll show you the vault reports. They'll show you the tiny handful of people who understood early that silver was never just another commodity. It was always the spring in the machine. And right now, that spring is starting to move.